Let's bring in Dean Curnutt, Macro Risk Advisors, to get a clinic on volatility. Great to have you here.
Good to be here.
The VIX, what's the number one thing the public gets wrong about the VIX?
Well, I actually think the number one thing it's the investment community gets wrong about the VIX, which is it's really short-dated. So I think when people think about volatility, the VIX is really just 1 month. It's a very short-dated instrument, and as such, it just tends to really inversely track the direction of the stock market more than anything.
What's the correlation? Stock market goes up, the VIX goes down. They go opposite of each other. Is it 1-to-1?
It's on the order of 85%.
Cool.
It's very close.
So it is very close.
Very tight, yes.
What does a pro do when it deviates? We'll say the VIX is not tracking the S&P. What does that signal?
Well, I think there's instances, for example, when volatility can actually rise when the stock market's rising. So think tech bubble. You had a situation in 2000 where these stocks were going to stratospheric levels, and all the while volatility was actually going up, not down. So that was, to me, that's an indication of a bubble. Mm-hmm. We saw that in silver recently, where the end part of the rally in silver coincided with a huge ramp up in volatility. We saw that in oil in 2008 as well.
Brilliant. Let's look at the chart here, folks. This is the VIX. I look at this all the time. Excuse me, back 20 years. You can see below the yellow line, which is 20.22, the average back there, the complacency in the middle 90s, the complacency in the middle aughts. And there is that emotion, that spike up there any number of times. We're just below average. What does that mean when average is 20 and we're at 18?
Well, I think, again, the VIX really is more a statement about what the day-to-day shifts or lack thereof are in the S&P 500. Right now, yesterday was a big move in the S&P, but you're not getting enough of those big moves that constitute the energy of the index to create realized volatility. So if I'm an options trader and I buy these options and I'm not getting these swings, that's how I make money. The lack of swings is causing me to lose money. That's driving the VIX down. So it's really a function of the fact that the S&P, outside of yesterday, has been relatively quiet for a period of time.
Which means that for traders, range-bound is not a good word.
For the people that are buying the options, that's the death knell.
Okay, MOVE. This is obscure. Let's bring it up. This is a cool chart. The MOVE index. This is not the VIX index, even though they look a lot the same. It's a Merrill Lynch option volume index, and it's sort of like the movement of the yield curve. And again, almost a complacency, a lethargy. Do you take that back to the economics of our system? Or is that there's a jargon alert for the word lethargy? Come on, it's a malaise, a lethargy. It's like we're on Quaaludes. Okay, so the bond market's quiet as well. What does that signal to you?
Again, this is a measure of option implied volatility in the bond market. So it's the VIX of the bond market, and it really says the same thing. The day-to-day movements in the bond market haven't justified a higher level of this MOVE index, and really you'll see that across every single level, every single asset class, whether it's commodities, FX, equities, or rates. Option traders are pricing options based on the day-to-day movements. They're not pricing them off what a future reality, an economic reality or financial reality might look like, and that to us is a huge mistake.
Here we go, folks. Earlier this morning, Bloomberg surveillance, Mohammed Al-Arian. See the article out at Bloomberg.com. They wrote that up nicely thanks to Dave Litkin and his team. I asked Dr. Al-Arian what he thinks about when investing.
We're living in a multi-speed world. So as much as we may worry about the slowdown in advanced economies, there are sectors within advanced economies that are doing very well, the multinationals, and there are other parts of the world that are doing well. Secondly, balance sheets matter. So look at levels and not just changes, and make sure, whether it's on the sovereign side or on the company side or on the individual side, that you are investing with strong balance sheets.
Where are those opportunities now? Where are those balance sheets now?
Well, balance sheets have been repaired quite well. The Fed's engendered this very easy policy of money. It's allowed companies to term out debt. So if right now, if you look at, for example, the relationship between the VIX and the corporate default rate, strikingly high. There's not a default in sight right now, and that's a function of the fact that credit conditions are very generous. They're very easy.
So how do you react to that? How do you capture the potential of those companies? Do you just go long?
Well, if you think that the company's got a very clear growth path and you think that the balance sheet is very stable and they've got great management, that's where you're looking for opportunity. Our focus at Macro Risk Advisors tends to be to step back and say, what are the systemic forces that actually may overwhelm at a given point in time the fundamentals?
I think Dean Curnutt with us, Macro Risk Advisors. We're talking systemic risk. Note of the day. Note of the day. Here it is. Let's bring it up here. Carl Weinberg, you can look at it down here, Dean. Note of the day on one of the risks out there. There are multiple schemes on the table to lean on creditors to accept scrip or long-term bonds instead of cash when their bond holdings mature. Carl Weinberg, I mean, that's just one of the risks out there, isn't it, in Europe?
Oh, Greece is, I think, it is the most immediate risk, but it just speaks to the larger problem that the developed
chronic.
world.
We use the word chronic here.
Yeah, I mean, we're sitting on so much debt; it's intractable, and it threatens to overwhelm even the United States of America if something's not done.
You have arguably phrase of the year. I haven't figured out what phrase of the year is yet, but it's the octagon of uncertainty. I love that. It's like one of those sci-fi, TV shows from a zillion years ago. What is the octagon of uncertainty?
Well, an octagon has 8 sides, and from our standpoint, as we assess the systemic risk landscape, we're trying to figure out what are the things that might come up to really derail this, Bernanke-inspired asset reflation campaign? And we have an octagon, and there's no shortage of, important elements to it. There's housing, there's the sovereign crisis, there's a potential spike to crude, there's an earnings slowdown, a global growth slowdown, which has really kicked in. Should
I focus on how are we going to get out of QE2, or is it more important to focus on what is QE3 going to be?
Yeah, I'm not so sure that QE3 is in the cards right now, but what I am concerned about is that the ability, you mentioned the banking system. The banking system it's limping along. It's either that credit is not that desired, or its ability to generate credit via this broken money multiplier has been so compromised that we had an economy that was very credit growth oriented, and if we're looking to what's going to mobilize the economy in years to come, the banking system's not going to provide the impetus that it once did.
What do you do with an octagon of uncertainty? Do you short? I mean, where are you deploying assets now at Macro Risk Advisors?
Well, we've been talking about volatility in the VIX, and I think one thing to really keep in mind is that volatility is about carry, and if something's expensive right now, no matter how bearish you might be going forward, investors shy away from it, and that's what drives the VIX down to 15. It's that the S&P is only realizing 5 or 8, so that carry becomes very punitive. That said, we tend to think about volatility from a going forward standpoint, so we've been actively setting up hedges. There's many creative ways to do it. These risk asset hedges are, you can do them through ETFs. VIX options actually are quite liquid, so we've been able to do some creative.
They're not a gouge. You can do a VIX option and play and not get killed in the spread.
Yeah, the liquidity's gotten far better. At the end of the day, we think the most important instrument remains the S&P 500. It's the deepest options market by many measures in the world, and that's where the world's beta is. It's to the S&P.
To the S&P, construct one trade. Take an institutional trade and just talk it to me. I want to show my viewers how complex some of these trades can be.
Well, there's the thing about options that's so interesting is that they've got a direction. They've got a skew to them. So in other words, there's a strike price,
right.
And depending on what
price.
Right. So depending on what strike price you choose, there's a volatility associated with that.
Right.
That's a unique volatility, and then there's a time to expiration.
Time is out here. Theta's out here.
Exactly. So neither of those is a characteristic of equities. You just buy or sell the stock.
You buy those
options,
Greek letters.
That's right. And those Greek letters are very determinant of how the exposure of the option materializes through time.
On the SPX right now, what are you doing with theta? What are you doing with the view out?
Well, the view out can be pretty punitive right now. So the term structure of volatility is very upward sloping.
Yeah.
And the reason that's upward sloping, I think, is because there's this concern on a mark-to-market basis that if Bernanke lets up on the gas, or if there's this fiscal unwind, eventually a reckoning of the fiscal spending by the United States, that will create some risk-off event. The further out you go from a volatility standpoint, the market's charging you more. That's the upward sloping term structure. Exactly.
Short that, go long the inside. That was great, Dean. Thank you so much, Dean Curnutt, Macro Risk Advisors. Just a little window into there of how the pros construct the trades around their beliefs, what are much the same as the beliefs that we have. Let's look at